Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Andrew Mushbaugh, and I'm joined, as always, by my co-host, Trent DeBruin. And today we're going to talk through 5 common myths around managing your finances. And we had to add in the part about myths around managing your finances so I don't go off track and discuss the myth that Jim Harbaugh will finally turn Michigan football around.
Yeah, that's probably the best, both for our listeners and also for your own benefit.
Yeah, I don't think we could squeeze in enough time to fully dissect that, but that's all right. I'll just keep believing that this will be the year for Michigan football.
Hey, knock on wood, but eventually you'll have to be right at some point.
Well, thanks for the support. All right, back on track here. We're going to touch on 5 common myths around managing your finances. And the first one is around the idea that I need to make a change to my investments based on XYZ headline. The second one is thinking that once I have a certain dollar amount or portfolio size, then I'll feel comfortable. The third one is a relatively timely one here after finishing up tax season a couple months ago, which is thinking that a tax refund equals good tax planning or owing taxes equals bad tax planning. And the fourth one is one that hits home especially hard for us as advisors, and that's spinning a positive light on whole life insurance as a way to combine covering your insurance needs while investing at the same time. And the last one is number 5, which is the general advice of saying save 20% of your income toward retirement and you'll be fine. So Trent, why don't you start us off by talking through the first myth of needing to make changes to your investments based on the headlines?
Sure. I think this is probably the most common myth out there because of the 24/7 media coverage and access to information, along with the short-term focus.
Yeah, the focus on short-term periods is comical. A couple weeks ago, I saw a headline that this was the worst week for stocks since February.
I'm still waiting for the headline that says it was the worst day for the stock market since yesterday.
Yeah, it's probably coming next to this rate.
Yeah, it really wouldn't be surprising. And that's why this short-term focus and the way the financial media reports various headlines tends to create a false sense of urgency that you should always be doing something at any given time. And it's not that the financial media is inherently trying to cause damage or lead people to making poor decisions. They just have a different goal than investors have. They're trying to get clicks and engagement with their headlines because that's how their business works, where they make more money if more people watch or click on their stories. And the way they do that is by coming up with dramatic headlines, like worst day in the stock market in over a year, or markets at all-time highs despite rapidly rising inflation, or market signaling looming recession could be worse than 2008. The financial media has to stay current and create an edge to get people to engage with whatever they're putting out there, so they perpetually try to create a narrative that something is more important or dire than it really is. Because if you look at it objectively, it wouldn't take long for one of the financial media companies to lose their audience if they just wrote articles saying, don't panic or react to the headlines of the day and instead focus on a sustainable long-term investment strategy.
That would be nice if they did that, though.
Yeah, it would be, although I'm not holding my breath that they'll do it anytime soon. And taking it a step further, outside of the financial media trying to get clicks and engagements with their headlines today, they also want to encourage you to come back to read articles and engage in the future. The way they do that is by trying to shorten the time horizon that you focus on. For example, a jobs or unemployment report coming out on Thursday, monthly inflation numbers, the Fed talking at 2 p.m. today, XYZ company beating their earnings or not beating their earnings. There's always something going on, and they're happy to bring on any quote-unquote experts to offer an opinion on what people should be doing right now in response to or in anticipation of these short-term events. So between those factors of getting you to click on an article by creating dramatic and urgent headlines and encouraging a short-term focus, they create a misleading narrative that there's always something you should be doing to navigate whatever's happening or will happen in the near term. And reading the daily headlines of the market is at an all-time high despite skyrocketing COVID cases or dire jobs report signals recession ahead creates this feeling of uncertainty. And that uncertainty often leads to thinking you should either wait to invest until whatever crisis of the day passes or switch out of this or that investment into another one, along with a host of other potential mistakes. And that's not to say there isn't merit to the news or that these various events won't have an impact on your investments, but rather to point out that the financial media doesn't know your unique situation or have an interest in providing advice on what will help you be a better long-term investor. This past year perfectly highlighted the disconnect that often takes place between what's happening in the economy or is being reported and what's happening in the stock market. If you just read headlines over the past 18 months, you may have been tempted to sell during the market decline of February and March of 2020 before things got, quote, even worse, then waited to get back into the market until we had certainty that COVID was behind us, the economy was recovering, and the volatility around the presidential election had passed. If you did panic or make changes to your investments based on the dire news reports, you would have missed out on one of the best one-year stock market recoveries of all time. In a little over a year, we saw the headlines shift from steepest stock market decline in history to stocks at all-time highs. And this is just one example, but it's a consistent theme when you look out across decades, namely that no one has a crystal ball for the future. even the quote-unquote experts who appear on TV. And the more you speculate in the near term, the more likely you are to make mistakes, and the worse your long-term investment returns end up being. So the punchline here is the importance of realizing how the goals of the financial media aren't aligned with you making smart long-term investment decisions. And mistakes can and typically do happen if you react to them.
Yeah, and my takeaway would be to turn off CNBC unless you like getting yelled at by Jim Cramer.
Who doesn't love that?
So transitioning away from CNBC and the financial media, the next myth we'll touch on is one on a more personal level. It's the belief that once I have $1, $2, or a $3.8 million portfolio, then I'll be happy and content. In a lot of ways, this is similar to the idea that the grass will be greener on the other side. You think that once you switch jobs, get the promotion or raise, you can finally travel, that then you'll be able to relax and everything will be exactly as you imagined. With those areas, we know there's a temporary boost where you're satisfied with the change, but then reality sets in and it becomes the new norm. This grass is greener mentality shows up in a lot of places, but we'll just focus on how it applies to reaching a certain portfolio size or net worth, at which point you magically feel content and no longer stress about your finances. It sounds appealing and can make things feel better today, thinking that in the future, all of the saving and investing and potential stress you're going through today will result in you not worrying about the day-to-day stock market movements or running out of money in retirement, and now you'll be able to be stress-free from that point on. Unfortunately, that's not the case. Having 2 million, 3 million, or 7 million doesn't by itself allow you to feel content and tune out the same stresses you had accumulating that investment account balance. It certainly can help and won't hurt having a larger cushion to where you can think less about money, but the problem is targeting an arbitrary target account balance as the end goal. Now, I should probably add the caveat here that there's nothing wrong with having an aiming point, and there is a reality that you will have to accumulate a certain investment account balance before you are financially independent or can retire. The problem isn't around being diligent with saving and investing, but rather thinking that once you reach that point, things will magically feel different. The reality is that once you reach that point, it can anchor as a new normal and hold too much weight as a point of significance. I'm sure some of you know or have heard of someone who has $10 million and still clips coupons or stays at motels versus hotels, just like you've heard of someone who overspends using credit card debt to the point of no return. And taking the example of the coupon clipping $10 million person, they can certainly afford to pay full price or stay at nicer hotels, but there is a reason they don't. It could be on principle, they enjoy finding nice deals, or they've just built the habit of saving every last penny. If they had 6 million or 12 million, do you really think that would change anything? Now, those are obviously the extremes, but take two different couples in their 60s that have a $2 million investment account balance. One may feel like they have more than enough, while another couple might feel like they're going to run out of money by the time they're 75. This is where everyone has a different mindset or view on how much is enough for them to feel content. And using the couple that feels like they'd run out of money with only a $2 million portfolio, it's helpful to dig a little deeper to understand why. It could be because they're concerned about their investments going down with another 2008 or March of 2020 decline, a general sense of unease of not knowing it will last throughout their retirement, a life experience where they were scraping by, or a more practical level just because of their lifestyle. The first step is addressing the practical question, which is looking at your lifestyle relative to your spending to see if it's sustainable throughout retirement and making sure you have enough saved up to accomplish that. But once you get past that point, there's no one portfolio value that will take away all the other stress because it's always going to fluctuate throughout retirement, going either higher or lower than that target amount. And placing too much value on a target investment portfolio often results in unnecessary stress. Ultimately, money in your investments are just a means to an end of being able to do more of what you want when you want. And past a certain point, you'll be in for a disappointment if you think having an extra $200,000 or $500,000 will make you feel materially different in the future. The main takeaway here isn't to avoid setting a savings target or portfolio account balance to be able to be financially independent or retire. It's just to not place too much emphasis on how different things will feel or be once you get there.
And we know that's a lot easier said than done, and this is where the qualitative or emotional aspect of managing your financial life comes into play more often than people may like. And another area where it comes into play is around taxes, which is the next common myth we'll touch on. For some people, seeing the amount you had to pay in taxes last year may still be lingering, while others may have moved on, but regardless of where you stand, there's often a lot of confusion around taxes and what represents good versus bad tax planning. For most people, when you look at your taxes and file your tax return, the main number you focus on is the amount of refund you'll receive or the amount of taxes you owe. And this is also where the most confusion comes into play. There's a misperception that if you received a refund, you or your accountant did a, quote, good job with your taxes and tax planning. Or conversely, if you owed taxes, that you or your accountant did a bad job or weren't planning properly. However, that's not the case in the way most people think about it. Getting a refund or owing taxes is simply the difference between what you had withheld for taxes throughout the year, through your employer or through paying quarterly estimates, and what your tax liability was for the year. Your tax liability is what it is based on your situation for the year, the income you earned, your deductions, etc. If you owe $60,000 in taxes, you're going to owe $60,000 in taxes. The amount of a tax refund or the amount of taxes you have to pay when filing your return is just the difference between that $60,000 tax liability and what you withheld throughout the year. If you withheld $50,000, you'll owe $10,000 at tax time. If you withheld $65,000, you'll receive a $5,000 refund. The only difference is the timing of when you pay the tax liability, which is the one caveat to add here, that there are penalties for underwithholding throughout the year, since the government likes to get its tax dollars as soon as possible. So owing taxes or receiving a refund isn't inherently good or bad, unless you didn't withhold enough and have to pay a penalty. And this is where understanding the difference between tax preparation and tax planning is important. Tax preparation is preparing and filing your tax return based on what's already happened. The end result of it is finding out whether you owe taxes or will receive a refund. In other words, it's a reactive activity. Tax planning, on the other hand, is proactive planning in terms of looking at what you can do ahead of tax preparation to lower your overall tax liability and ensure that you're withholding enough for taxes throughout the year. Which, if you'd like to hear more about tax planning, we discuss it in more detail in episode number 3, How to Save on Taxes as an Employed Physician, and also episode 15, How to Minimize Your Tax Bill in Retirement. So the main takeaway here is to understand that getting a refund or owing taxes has very little and usually nothing to do with good or bad tax planning.
Yeah, exactly. Though regardless of good or bad tax planning, it's never fun writing that check when you owe taxes. Another check people don't like writing over time is the check for insurance premiums, regardless of how big of a check it is. Which, to make matters worse, you write the check for the life insurance coverage, hoping that you never actually have to receive any benefits from it. Having said that, the peace of mind and protection life insurance provides in the event something happens to you makes it an easier pill to swallow. And this is where the next common myth comes into play, and is one that is especially relevant for physicians, as they seem to be targeted more than other professions. The myth is that instead of paying for life insurance premiums each year and hoping to get nothing in return, there's a better alternative that allows you to save and invest while also having the same life insurance protection. This alternative I'm describing is permanent life insurance, also referred to as whole life or universal life insurance. Like I just mentioned, with life insurance, you hope that the money you pay each year in premiums is effectively lost money, and you never have to receive money from it, which is where the salespeople come in with this product that sounds like the best of both worlds. The pitch these insurance salespeople make is that you can buy a life insurance policy to protect your risk of a premature death, but also can take advantage of saving some of your premiums along the way that you can use in the future to take out as tax-free distributions. For those of you who may not be as well versed in financial literacy, on the surface, it sounds like you get the best of both worlds. You get insurance protection, a savings component, and tax benefits. So what's not to like? Well, first, if something sounds too good to be true, it usually is. Similar to the financial media, you have to understand that companies aren't offering products out of the goodness of their heart, and they are selling you a product where they will make money off you. On top of that, the insurance agents that sell you these products are highly incentivized to get you to pay as much in premiums each year as possible, because they'll get anywhere from 50 to 100% of the premiums you pay in the first year, along with an annual payout each year that you keep the policy. And more often than not, you'll have a conversation, maybe get some free advice, and then once you buy the expensive permanent life insurance, you may never hear from that insurance agent or quote-unquote financial advisor again. Before walking through why permanent life insurance is really ever a good idea, it's helpful to first understand what the purpose of life insurance is. Life insurance is meant to protect against a risk for as long as you have a risk. Once you're financially independent or in retirement, you're self-sufficient from a financial perspective, and there's no longer a need for life insurance. Knowing that, the idea is that you want to pay as little as possible over the time period where you need to have life insurance, which the way to do this is by buying term life insurance. Term life insurance could cover you for a period of 10, 20, or 30 years, and then the coverage goes away, hence the name term. You can get several $1 million worth of coverage for potentially $1,000 to $3,000 a year. Now compare that to permanent life insurance, where to get the same coverage, it typically ends up being 5 to 15 times the cost of term life insurance. So for $2 million of coverage, instead of paying $1,000 a year, you may be paying $5,000 to $15,000 per year for the same life insurance coverage. Purely from an insurance perspective, why would you want to have to pay 5 to 15 times the cost for the same death benefit life insurance protection? Well, the obvious answer is you wouldn't. Yet this gets pitched as a lifelong insurance policy, so your spouse or family will still get some death benefit down the road. But like I mentioned, you'll eventually get to the point where you don't need life insurance. So why would you want to keep paying for a policy or overpay for 10 to 30 years for insurance to eventually be at a point where you don't need it? Now, the next sales pitch is that you are paying more in premiums because you also have an investment component. So some of the premiums you pay each year will go toward a cash value that grows over time. So now the conversation shifts to viewing the extra $5,000 to $15,000 of premiums as an investment rather than just for insurance. When you look at it from this lens, it's simply comparing the rate of return you'd earn on the money you pay in premiums relative to what you could earn on that money by investing elsewhere. Since the insurance agents that sell the policies get paid a hefty commission on the front end, the insurance company wants to ensure that they make money, which means if you bought the policy one year and cancel it the next year, your quote-unquote investment would already be negative. And this continues for several years as the insurance company is able to recoup the commission they paid to the insurance agent. Looking longer term, over say 30 to 40 years, the rate of return you end up earning on your cash value or investment component of the permanent insurance ends up being around 3 to 4%, which compared to investing that elsewhere in the stock or bond market, you can reasonably expect to earn a better return, with stocks historically earning an average of 10% per year and bonds around 4 to 5%. So the punchline here is that while permanent life insurance sounds like the best of both worlds, it really just ends up being an expensive way to pay for insurance coverage while investing in something with a lower than average expected return. Essentially, it's like the idea of trying to do two things at once where you end up doing both poorly. Instead, a better approach is to buy term life insurance and use the additional money you save in premiums to invest elsewhere.
Yeah, this one is especially frustrating because of the confusion the insurance agents often create when trying to sell these policies. But we're hoping we can help as many people as possible avoid making that mistake. And the last myth we'll touch on is around the idea of general financial rules of thumb and how they can apply to everyone. And one in particular is the idea of save 20% of your income toward retirement and you'll be fine. And before we dive into this in more detail, we do want to say that general rules of thumb are still a good starting point, and they're often better than nothing. But when it comes to personal finance, unfortunately, it's not a one-size-fits-all approach. The reason this idea of just save 20% for retirement and you'll be fine doesn't always make sense is that it doesn't factor in your unique situation and goals. If you wanted to retire at age 50, depending on your lifestyle, saving 20% may not be enough. On the flip side, if you always want to work or plan to work into your late 60s, then 20% might be more than you need to save toward retirement. In either case, it's all about striking the right balance for you in terms of enjoying things along the way, while also saving for whatever future goals are most important to you. And the only way to really know how much you should be saving is to go through the process of mapping out, at least roughly, what your future goals are, and then working backward into a savings target that allows you to reach those goals. On top of that, you'll likely need to make some adjustments over time based on how things actually play out. For example, your investment returns may be better or worse than expected, which could change the amount you need to save toward retirement. The other potential issue with this general rule is that it often creates a false impression that this is an exact science. Is it 20% of my gross pre-tax salary, or is it 20% of my paycheck? Do I factor in any matching contributions from my employer, etc.? From our perspective, it doesn't matter where the savings come from, and it's not about hitting a certain percentage. Instead, the focus should be on a set dollar amount. Say you run the projections and realize you need to save $60,000 a year to meet your future goals. Does it really matter if that ends up being a 15% or a 28% savings rate? The other aspect is that your life will change over time as old expenses, things like student loan payments, go away, and new expenses or savings goals come in, buying your dream home, saving for college, etc. Percentages can be a good starting point as a benchmark, but the reason we think it isn't the best advice is because it doesn't factor in the reality that everyone's situation is unique. If you started saving earlier, you may be able to reduce the amount you save in the future. And on the flip side, if you had a delayed start to saving, you may need to increase the amount you save to catch up on those missed years. Regardless of where you stand, the main takeaway is to avoid thinking that a general rule of thumb applies to everyone, and that if you hit that target, you'll automatically be on track to meet your future goals.
Yeah, it's tempting to think there's a shortcut or one-size-fits-all rule, but unfortunately that's not the case, and finding that out earlier rather than later will help to avoid any surprises down the road. Well, hopefully that was a helpful discussion and cleared up some confusion on some of the common myths that you may have come across or been thinking about. We know there's no shortage of information out there and conflicting opinions of what people are telling you, which is why we always encourage people to try and simplify things wherever possible. So to give a quick recap of the 5 myths that we went through, the first one is around thinking you should be changing your investments based on the headlines or what the financial media is worried about in that day, which, as we discussed, the financial media has different goals than giving you sound investment advice, and by tuning out the day-to-day noise, you'll end up with a better long-term investment return. The second myth is thinking that once you have a certain investment account balance, you'll be content and won't have to stress anymore. And while there's nothing wrong with having an aiming point, it's important to not place too much emphasis on a precise dollar amount because it won't actually feel different once you're there until you internalize what enough is for you at a general level. The third myth is around getting a refund or owing taxes and that dictating good versus bad tax planning. However, the difference between getting a refund or owing taxes is simply the difference between what you withheld for taxes throughout the year and what your actual tax liability for the year was. This is where you want to understand the difference of tax preparation, which is reactive, versus tax planning, which is proactive. The fourth myth is thinking that permanent life insurance can be the best of both worlds, with having life insurance coverage while investing at the same time. Yet the reality is permanent life insurance just results in you overpaying for insurance and investing additional cash into a product with a lower than average expected return. A better approach here is to purchase term life insurance and invest the saved premiums elsewhere. And the last myth is around general rules of thumb and thinking that if you save 20% toward retirement, that you're on track. So while it's a fair starting point, you need to understand how that equates to a dollar amount and whether that savings amount is enough to meet your unique situation and goals. Well, thanks everyone for joining us on another episode of the show. If you want to check out the show notes, you can find them at mdwmllc.com/podcast. And as always, you're also welcome to email us at info@mdwmllc.com if you have any thoughts to share or questions to ask. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.